Hello everybody, I'm Sylvia. It's with me again. I'm a student of IPMI International Business School, Magister class. This time I will share with you the overall session of corporate finance class that was conducted by Professor Resemble. The class was started with a discussion of financial management fundamentals that deals with the creation, maintenance, and enhancement of economic value or wealth. Remember, there are three groups of financial decisions for corporations. The first is investment decisions, involve allocating scarce financial resources across competing uses. And then the second is financing, involve raising funds to finance the investment project. And the third is dividend decisions, involve investing cash back to the business or returning cash to the shareholders. The investment decision always involving financial tools, and there are three ways to measure for making an investment decision or projects. The first one is the NPV, net present value. This is the difference between a project's value and its cost. And then the second is the profitability index. This is helpful in ranking various projects because it lets investors quantify the value created per each investment unit. And then the third is the internal rate of return. This is used in capital budgeting to estimate the profitability of potential investment. And then the analysis of securities. The analysis of securities consists of fundamental analysis, technical analysis, and investor sentiment analysis. For the fundamental analysis, this is the analysis of the business financial statements, health and competitors, and also the markets. It also considers the overall state of economy and factors including interest rates, production and earnings, employment, GDP, housing, manufacturing, and management. And then the technical analysis is technique to examine and predict price movement in the financial markets by using historical price charts and market statistics. And then the investor sentiment analysis is the qualitative measure and methods that includes the effects of market psychology in a trading strategy. From the fundamental analysis, we can use a criteria of performance indicator to measure that one company is healthy or not. By measuring the return of asset and return of equity of one company, we can see their profitability. And then by measuring the company's current ratio and quick ratio, we can see the liquidity ratio risk of the company. Then by measuring the company's total asset turnover and total fixed asset turnover, we can see the return of this company. And then by measuring the company's debt to asset ratio and leverage ratio, we can see the leverage ratio of the company. And then finally, by measuring the company's dividend yield per earning ratio, we can see both the return and risk of this company. And then we can move to technical analysis. We can see patterns in price graph. We also see the momentum versus reversal and the trend, uptrend, and then downtrend, and then support, the resistance, the gap common, breakaway, measuring exhaustion gap, and then triangle, symmetric, asymmetric, and then double bottom, double top, and then head and shoulder, inverted H and S, moving average, and then the filter rule. And then we can move to the capital structure. Capital structure is the particular combination of debt and equity used by the company to finance its overall operations and growth. The debt comes in the form of bond issues or loans, while the equity may come in the form of a common stock, preferred stock, or retained earnings. Factors that determine optimal capital structure is the tax benefit and expected cost of financial distress. Okay, sometimes in the company there are frauds that can be happen. Let's take a see for the early warning signal for fraud. Because sometimes employee has frequent loss or missing documents and then often conflict of interest, lifestyle beyond income capacity, often borrow money from colleagues, and then look very busy, but low productivity. So we can see the early warning signal for fraud for one employee. And then how to prevent fraud in your company. We can build employee ethics and then write SOP that have to follow if fraud event is suspected or discovered or identified. And then train employees to increase alertness for fraud and how to prevent fraud, including financial control procedures, IT security, and etc. And then have the protective security from the hardware and from the software also, and then create whistleblower mechanism in your company. That is also to obtain the greatest findings. And now let's continue to arbitrage. Arbitrage is the act of buying a security in one market and simultaneously selling it in another market at a higher price. This is enabling investors to profit from the temporary difference in cost per share. There are three arbitrage strategies. First is locational arbitrage, capitalizes on discrepancies in arbitrage, exchange rates across locations. And then the second is triangular arbitrage, capitalizes on discrepancies in cross-exchange rates. And then covered interest arbitrage, capitalizes on discrepancies between the forward rate and the interest rate differential. And then we can talk about the dividend. There's questions always about should a firm use retained earnings, that is for financing profitable capital investment, or paying dividends to the stockholders. If we retain earnings for profitable investment, dividend yield will be zero, but the stock price will increase, resulting in a higher capital gain. If we pay dividends, stockholders receive an immediate cash rewards for investing, but the capital gain will decrease since the cash is not invested in the firm. So firm has to decide how much of the firm's earnings should be distributed to the shareholders as dividends and how much should be retained for the capital investment. And then in the sixth session, Professor Roy Semble invited a guest lecturer. He is the director of BCA Bank, Mr. Henry Kunaifi, who has explained how banks can survive in the COVID-19 crisis era. I noted two major points here. The first one is the comprehensive policy mix to help stabilize the economy. The first is financial stimulus that comes from the government, and then the monetary policy, and then the currency stability, and then the mitigating liquidity risk, and then the credit restructuring, and also the relaxation of banking regulations. And I also note that banks have self-anticipation, that is to improve the credit quality. Banks should be very careful to grant the loan, and then aware of the industry segment of the debtors. Prepare the research fund, especially to anticipate the non-performing loan, and then tightening the credit review of risk appetite. And then finally, to strengthen the digital innovation for all mechanism and transaction. Right now, close to the 90% of the transaction is a cashless transaction, while only 10% of the transaction is the branch-based transaction. Okay, this all my sharing to you regarding the overall corporate finance class that was conducted by Professor Resemble. I would like to thank you to him, and also I would like to thank you to always follow my video. Thank you very much. Stay healthy and happy. Bye.